Over the past year, one quiet trend has been accelerating across corporate America: the rise in share buybacks. Companies across technology, energy, healthcare, financial services, and industrial sectors are announcing large repurchase programs. Billions of dollars are being allocated to buying back their own stock. On the surface, this looks like confidence. A company that buys its own shares is signaling that it believes in its future. But beneath that surface lies a deeper strategic question. What does the rise in share buybacks really signal about growth? To answer that, we have to start with capital allocation. Every dollar a company generates can be deployed in one of several ways. It can be reinvested into the business through research and development, expansion projects, hiring, or acquisitions. It can be used to pay down debt, or it can be returned to shareholders through dividends or buybacks. When buybacks rise significantly, it tells us something about how executives view their growth landscape. In high-growth eras, companies typically prioritize reinvestment. When attractive expansion opportunities are abundant, capital flows towards scaling operations, building new facilities, entering new markets, launching new products. These activities take precedence over repurchasing shares. So when share buybacks increase, it can signal that growth opportunities are becoming more selective. That does not mean growth has disappeared. It means management believes the best risk-adjusted return, at least for a portion of its capital, is to reduce share count rather than expand aggressively. Many industries are now operating in mature phases. Cloud computing remains large and important, but it is no longer in early hypergrowth mode. E-commerce penetration is high. Consumer technology markets are saturated in developed economies. Enterprise software adoption is widespread. In mature markets, revenue growth naturally moderates. Companies still generate substantial free cash flow, but the number of high-return expansion projects may narrow. Buybacks become a rational response. Another layer behind rising buybacks is capital discipline. Interest rates are higher than they were during the ultra-low rate period. Capital is more expensive. Investors are more selective. Markets reward profitability and free cash flow more than speculative expansion. In this environment, companies are cautious about overcommitting to aggressive projects that depend on uncertain demand forecasts. Returning capital through buybacks preserves flexibility. Unlike building a factory or launching a new division, buybacks can be adjusted quarter by quarter. They are reversible. They allow companies to reward shareholders without permanently increasing fixed costs. So what does the rise in share buybacks really signal about growth? It may signal caution about accelerating top-line expansion in uncertain conditions. There is also a valuation component. When executives believe their stock is undervalued relative to long-term earnings potential, buybacks can represent a strategic investment. Reducing the number of outstanding shares increases earnings per share and can enhance shareholder value over time. In that case, buybacks signal confidence in core stability rather than a lack of growth ambition. Artificial intelligence adds complexity to this discussion. AI infrastructure spending is massive in specific sectors, such as semiconductors and cloud services. But not every company needs to invest directly in building data centers or designing chips. For firms that benefit from AI through software integration or productivity gains rather than infrastructure build-out, free cash flow may exceed immediate reinvestment needs. Buybacks become a tool for balancing capital deployment. The broader rise in buybacks also reflects the law of large numbers. Many of the largest U.S. corporations generate enormous cash flows each year. When annual revenue is already in the hundreds of billions, sustaining rapid percentage growth becomes mathematically difficult. In that context, earnings growth increasingly comes from efficiency improvements, margin protection, and capital optimization, rather than aggressive revenue expansion. Buybacks contribute directly to earnings per share growth, even if revenue grows at a steadier pace. However, critics argue that rising buybacks can signal underinvestment. If too much capital is returned instead of reinvested into innovation, long-term competitiveness could suffer. The key question is balance. Are companies investing sufficiently in research and development, infrastructure, and strategic initiatives before returning excess capital? In many cases, the answer appears to be yes. R&D spending remains substantial across technology, healthcare, and industrial sectors. Infrastructure investments tied to AI and manufacturing continue. Buybacks are often funded after strategic priorities are addressed. Another important signal embedded in rising buybacks is confidence in cash flow durability. Companies would not commit to large repurchase programs if they believed earnings were fragile or short-lived. Buybacks suggest management believes current profitability is sustainable. That is a growth signal of a different kind. Confidence in stable long-term earnings rather than explosive expansion. The shift toward buybacks also aligns with investor preference for predictability. Markets have become less tolerant of aggressive expansion without clear returns. Companies that demonstrate disciplined capital allocation and steady shareholder returns are often rewarded with valuation stability. In that environment, buybacks serve as a bridge between growth and stability. So what does the rise in share buybacks really signal about growth? It signals that growth has matured in many sectors. It signals that capital is more carefully deployed. It signals that management prioritizes disciplined returns. It signals confidence in core operations. It may also signal that the era of growth at any cost has faded. In previous cycles, companies reinvested aggressively because capital was cheap and demand expansion felt limitless. In today's environment, growth still exists, but it must be earned carefully. It must justify its cost. Buybacks reflect that recalibration. They do not necessarily mean companies have run out of ideas. They mean companies are weighing opportunity against risk more rigorously. Growth in 2026 is less about dramatic expansion and more about sustainable performance. And in that context, share buybacks are not a retreat from growth. They are a signal that growth has entered a more disciplined, mature phase.